session to address your questions. And with that, let me hand it over to Bender to begin today's presentation. Bender, over to you.
Shukran, Sarah. Thank you. Assalamu alaikum and good afternoon, everyone. And thank you for joining us today. My name is Bender Mohanna, the CEO and Managing Director of Flynas. Joining me today, Ramzi Zaroubi, the CFO, Dr. Anurag Jain, the Chief Strategy Officer, and Rania Laom, VP of Investor Relations and Financial Planning. Let me start with a quick look at our performance for the third quarter. It was a strong quarter for Flynas, reflecting solid demand and showing the benefit of our continued network and fleet expansion. We received 2 aircraft, 320neo, in the quarter, in addition to the 5 aircraft received in the first half of the year. With that, we reach an important milestone, the delivery of our 60th A320neo aircraft, which means we have now taken delivery of half of the aircraft from our first order that been signed in 2016 with Airbus. The ASK production was up 22%, mostly driven by international network growth. This reflects the scale of expansion we are delivering, outpacing the KSA market growth in the quarter. Passenger numbers increased by 15% compared to last year. Revenue grew by 6% in the quarter, and adjusted EBITDA was up 21% compared to last year, supported by a better efficiency and scale. We closed the quarter with a healthy cash balance of 4.6 billion Saudi riyal, giving us room to fund our next phase of growth. Overall, the third quarter showed a clear pickup in the LCC segment from the second quarter and provided a strong base for our 9-month result. With that, let's move to the next slide to look at our performance for the first 9 months of 2025. As I mentioned, the strong performance we saw in the third quarter also lifted our year-to-date result. ASK production grew by 9% year-on-year, outpacing the growth of KSA market for the period. Passenger traffic increased 5% compared to last year, supported by continued network expansion and steady demand. Revenue was up 3%, while adjusted EBITDA increased 19%, reflecting the efficient growth and better operating leverage. This also positively reflected on the bottom line, which expanded to 426 million Saudi riyal. Let's move into the next slide to talk about some of the challenges we faced this year and how we have been addressing them. As you know, in 2025, we had to navigate a few headwinds along the way. On the supply side, engine availability remained an industry-wide challenge, with CFM spare engine delivery delays temporarily affecting the availability of our fleet. In the second quarter and early in the third, international traffic was affected by temporary visa suspension that came into effect unexpectedly. And finally, regional geopolitical tension softened travel demand during the second quarter and early part of the third quarter, mainly in July. Despite all that, we stayed proactive and focused on execution, adding a new route and expanding the network. We also expanded our fleet by 9 aircraft year-on-year, including 7 new A320neo, and made good use of wet lease capacity to accelerate growth and benefit from the peak season demand. This effort really helped us maintain momentum and deliver solid results, even in what was a challenging environment, and the evidence in our 3Q and year-to-date result. Now, let's take a closer look at how that played out, starting with the progress we have made in expanding our international network and growing our fleet. Let's start with the network side. 2025 has been a big year for expansion. We added 19 new routes and 9 destinations across 7 countries so far. That brings our total network to 150 routes, serving 77 destinations across 36 countries, which is a truly international footprint that keeps growing quarter after quarter. ASK was up 9% year-on-year, mostly driven by the international segment, as we continue to diversify our reach beyond the domestic market. Looking ahead, we expect this growth to continue into the fourth quarter. We plan to enter 2 additional countries and expect ASK growth of about 15% year-on-year for the quarter. We are also aligning seasonal capacity with winter demand and inbound tourism, making sure we capture the traffic flow during the busy travel season. Now, while the network has been expanding at pace, we have also made solid progress on the fleet side. Let's take a look at the next. Turning now to our fleet. This has been another year and another area of steady, disciplined growth for Flynas. As of the third quarter end, our total fleet reached 68 aircraft, up from 59 at the end of last year, including 7 new A320neo delivered this year. We expect to end 2025 with about 75 aircraft. This growth is fully aligned with our long-term fleet strategy, which focuses on expanding the 320neo family for fuel efficiency and network flexibility. We are also maintaining one of the youngest fleets in the region, averaging just under 4 years for narrow-body, which helps keep our operation efficient and our cost base competitive. To bridge the temporary capacity gaps from engine delivery delay, we continue to use a limited number of wet-lease aircraft, ensuring reliability and schedule integrity. And finally, our long-term maintenance agreement with CFM are helping us manage costs more predictably as we scale. So overall, our fleet strategy remains focused on efficiency, reliability, and growth readiness, all of which position us well for the next phase of expansion and help us navigate the headwinds we are facing. Now, let's take a look at how Flynas continues to strengthen its global profile before we have a detailed review of the quarterly result. Alongside our operational growth, we continue to strengthen Flynas' global reputation as a trusted and reliable carrier. All our efforts are paying off. Flynas has once again been ranked among the top 10 global low-cost carrier by Skytrax and named the best low-cost airline in the Middle East for the 11th year in a row. This recognition, along with our APEX 4-star rating, reaffirm the consistency and quality of our passenger experience. On the brand side, impactful initiatives such as Al Hilal 320 Neo livery, along with strong seasonal campaign and growing digital engagement, continue to enhance our visibility across our market. With that, I'll hand it over now to Ramzi to walk you through the result for the third quarter and 9-month period in more details. Over to you, Ramzi.
Thank you, Bandar, and good evening, everyone. This is Ramzi, Flynas CFO. Let's look together at Q3 performance. As we stated in Q2 earnings call, we have accelerated Q3 ASK production by 22% year-on-year, while load factor stood at 83%. This reflected the scale of our network deployment during the summer period. On the revenue side, RASK, as compared to last year, declined by 4%, which was mainly due to the international expansion at higher stage length and the increase by GACA of the airport building charge by Saudi Riyal 30 per passenger for international passengers effective 1st of July 2025. However, total revenue for the quarter grew 6% year-on-year to 2.1 billion riyal. On the cost side, we kept our focus on efficiency. Adjusted CASK was down 7% year-on-year, supported by lower fuel prices, higher aircraft utilization, and tight cost control. Adjusted EBITDA improved by 21%, reaching 617 million riyal. Adjusted net profit grew by 4%, reaching 87 million riyals, and return on invested capital remained healthy at 10%. We also continued to strengthen the balance sheet. Net debt to adjusted EBITDA improved to 1.2 times, down a full turn from the end of last year. Overall, it was a solid quarter, showing strong and profitable growth. Let's now look at the results for the first 9 months of the year. Revenue for the period was up 3% year-on-year, despite the headwinds faced in Q2. Adjusted EBITDA improved by 19%, reaching nearly 2 billion riyals, showing the impact of cost efficiencies and better operating leverage. Adjusted net profit improved by 18%, reaching 426 million riyals. These results highlight how the rebound in the third quarter helped offset the temporary challenges we faced earlier in the year. It's worth noting that 9-month performance also reflects a few one-off items which were fully explained during Q2 earnings call. A quick refresh of these items are on the next slide. So as you can see on the left, reported EBITDA for the first 9 months was 949 million riyals. After adjusting for a few one-off items, it comes to nearly 2 billion riyals. The main impact came from IPO-related cost, the ESOP charge of 982 million, and IPO expenses of 101 million, both recorded in the second quarter, again with no effect on net equity. We also adjusted for a 63 million riyals gain from sale and leaseback transactions. Prior year, it was 131 million riyals, as SLB is inherently variable depending on the number of aircraft financed through SLB for the period. On the right, after the same adjustments, our adjusted net profit for the 9 months was 426 million riyals. With that context, let's move to the income statement to look at the underlying performance. As you can see on the left, revenue for the first 9 months reached just over 6 billion riyals, supported by a solid expansion in the third quarter. Gross profit grew 3% to about 1.2 billion riyals, with margins holding steady at 20%. Recurring SG&A increased by 5% for the period due to higher marketing activities. As mentioned earlier, IPO-related expenses and the gain from sale and leaseback transactions are excluded from adjusted results to give a clear view of underlying performance. As a result, adjusted EBITDA was up 19% year-on-year and adjusted net profit by 18%. You can also see this reflected on the right, where both margins improved, driven by strong third quarter results. Adjusted EBITDA margin for 9 months this year improved by 5 percentage points to 32.5%, and net income margin improved to 7% from 6.1% in 9 months of last year. In short, our 9-month performance shows steady earning growth supported by our solid start to the year and a strong rebound in Q3. Let's now move to the next slide to take a closer look at the top-line trends. So let's start with key operating drivers for our low-cost carrier segment. Passenger traffic grew 15% year-on-year in the third quarter, bringing total passengers for the 9 months to 11.5 million, up 5% from last year. On the supply side, ASKs increased 22% in the quarter and 9% in the 9 months, reflecting our ongoing fleet expansion and broader network reach and outpacing the capacity growth of the KSA market. Load factor stood at 83% for the quarter and 9 months. That's slightly lower than last year, mainly due to the second quarter disruptions we discussed earlier. Overall, demand trends remain strong, with traffic growth more than offsetting those short-term pressures. Let's move to the next slide, which shows the revenue mix and unit revenue in more detail. Looking at the chart on the left, revenue in the third quarter grew by 6% year-on-year to 2.1 billion riyal. This was driven mainly by our core LCC operations, which were up 17% year-on-year, more than offsetting the seasonal shift in Hajj-related activity. For the first 9 months, total revenue reached over 6 billion riyals, up 3% compared to last year. On the right, you can see the RASK trend for the LCC segment. Unit revenue in the third quarter came in at 24.9 halalas, down 4% year-on-year, but that's a clear improvement from the second quarter when RASK was down by 13%. The reduction in RASK is mainly due to the international expansion at higher stage length in Q3, alongside the extended impact of geopolitical situation in the beginning of the quarter, as well as the impact of the increase by GACA of the airport building charge discussed earlier. On a year-to-date basis, RASK was down 5%, a manageable result given the strong capacity growth we delivered and the challenges faced in Q2. Overall, we continue to focus on optimizing network profitability and improving yield quality as we expand. Let's move to the next slide to take a look at unit cost trends. As you can see on the left, our cost of revenue grew 8% in third quarter and 3% in the 9 months, mainly reflecting higher volume of operations. Fuel remained our largest cost item, accounting for 26% of total direct cost in the 9 months. Fuel expense declined 6% year-on-year in 9 months 2025, driven by lower average fuel prices, which was partially offset by higher volume of operations. As discussed in Q2 earnings call, we started taking fuel hedging position in October 25 due to lower fuel prices and lower hedging premiums. Currently, 25% of our 2026 consumption, as well as 5% of 2027, is hedged at Brent 80 per barrel. Navigation and airport charges were broadly stable despite the growth in operations, reflecting economies of scale. Aircraft rental expenses were flat in the 9 months 2025, following the phase-out of wet-leased aircraft used during Hajj operations. Maintenance costs decreased 10%, mainly due to high base of 9 months 2024, which included A320ceo aircraft redelivery cost. Depreciation cost increased mainly due to the addition of 7 new aircraft and wet leases. Overall, our cost base remained well controlled despite significant operational growth, a clear sign that our efficiency measures are working. This translated into a solid improvement in unit cost. Adjusted CASK decreased 7% year-on-year in the third quarter and was 5% lower for the 9-month period. That's a strong outcome, especially as we continue to expand while managing inflationary pressures across the sector. Let's move on to the next slide to look at the SG&A expenses. We continue to manage SG&A with discipline while investing where it really matters for growth. Total recurring SG&A was up 5% year-on-year over the first 9 months, driven mainly by higher sales and marketing expenses, while general and administrative costs remained broadly flat. The increase was largely due to planned campaigns and promotional activity in the first half linked to new international destinations. These were targeted initiatives that directly supported revenue and brand visibility. Let's move to the next slide and look at our leverage and debt position. As you can see on this slide, our balance sheet is in a stronger position now than it was at the beginning of the year. Net debt came down to just under 2.8 billion riyals, helped by cash proceeds from IPO, additional funding inflows, and cash generated from operations. We did add some new bank debt during the quarter, mainly to support the fleet expansion and other projects, and lease liability edged up slightly with the fleet growth. Even with that, the overall balance sheet profile improved meaningfully. Our cash and short-term investments remain at a healthy level, though we expect some reduction as we continue investing in our expansion plans. The result is a much lower leverage level. Net debt to adjusted EBITDA is now at 1.2 times, down from 2.2 times at the beginning of the year. Let's move to the next slide and to look at our cash flows. During the 9 months of 2025, we generated 1.2 billion riyals in net operating cash flow, reflecting continued strong earnings. CapEx was around 1.1 billion riyals, mainly for aircraft and pre-delivery payments. Proceeds from aircraft sales amounted to Saudi riyal 418 million, reflecting SLB gain for four aircraft, as well as aircraft that was initially purchased and subsequently sold as part of sale and leaseback transactions. On the financing side, we had net inflows of 2.5 billion riyals, driven by the IPO proceeds and new debt facilities to support ongoing growth. These were partly offset by scheduled lease and financing repayments. Altogether, that brought our cash balance to 4.6 billion riyals, up nearly 3 times since the start of the year, giving us solid liquidity to proceed with our growth plans. Adjusted return on invested capital stood at 10.5%, still healthy, though naturally impacted by the larger equity base post-IPO. With that, I'll hand back to Bender to cover guidance, capital allocation, and closing remarks.
Shukran, Ramzi. As you have seen, we delivered strong results and accelerated growth in the third quarter, continuing to demonstrate solid operational and financial performance despite the challenges faced throughout the year. As highlighted in our second quarter update, the issues related to KSA visa restriction, geopolitical disruption, and CFM engine grounding had an impact on our growth and performance for this year. The good news is that our issue with CFM engine grounding will be eliminated by Q1 2026. To mitigate the impact on growth, we added 5 wet-lease aircraft by the end of Q2 to support growth during the summer peak season. These aircraft were retained in September, and we are now in the process of replacing them during fourth quarter. While we expect to grow capacity by around 15% in quarter 4, this will not fully offset the shortfall experienced in the first half of 2025. However, this mitigation came with a financial impact, which were manifested in higher aircraft unit cost, impacting net income margin. Given this factor, we are revising our 2025 full-year guidance. Revenue is now expected to increase by 2.5 to 4.5% year-on-year. Profitability remained solid, with an EBITDA margin of 30% to 32%, underscoring Flynas' strong cost discipline and operational resilience. Net profit margin is projected to be at 5.25 to 5.75%. On leverage, we expect net debt to EBITDA to settle below 2 times by year-end, in line with prior expectation and maintaining a comfortable, flexible financial position. Looking ahead to 2026, our guidance remains unchanged. We are targeting 16 to 18% revenue and slight margin expansion, with EBITDA and net income improving by 0.5 to 1% compared to 2025. Overall, our focus remains unchanged: growing responsible, improving retain, and strengthening the foundation of our next phase of expansion. Before we close, let me touch briefly on our capital allocation priority. Our approach to capital deployment stays disciplined and focused on supporting sustainable, profitable growth while keeping the balance sheet strong. We are guided by 3 main priorities. First, we continue to reinvest in fleet expansion to meet demand and scale the network efficiently. This remains the backbone of our growth strategy. Second, we are investing in ancillary revenue opportunity, developing product, partnership, and services that help diversify income and strengthen margin. And third, we are maintaining a solid liquidity position and prudent leverage level, giving us flexibility to fund future growth with confidence. These priorities reflect our long-term commitment to disciplined execution and profitable expansion as we continue to grow the Flynas platform. As we wrap up, I'd like to leave you with 3 key takeaways. First, our business model continues to prove its strength, resilience, profitable, and built an operational discipline. Second, we are well positioned for the next phase of growth. The IPO has strengthened our balance sheet and gives us the capacity to keep investing in fleet expansion and network development. And third, our focus remains firmly on execution. We have a clear plan aligned with the strong market fundamentals supporting our long-term growth. With that, I'd like really to thank you for your time. That concludes our presentation, and we would now be happy to take your question.
Thank you, management. Thank you for the presentation. Ladies and gentlemen, we will now start the Q&A session. If you wish to ask a question, please raise your hand or type it in the Q&A chat box. Now, our first question comes from the line of Umar Al-Hajri. Umar, please go ahead. You are unmuted.
This is Umar Al-Hajri. So I understand that you have updated your guidance, but we would like to understand what have went wrong with the third quarter, especially that you've maintained your guidance post the second quarter that we saw as a weak one due to the one-offs that you mentioned. So this is my first question.
Yes. Hello, Amari. This is Ramzi, Flynas CFO. As we mentioned in quarter two, we plan to take 7 wet lease aircraft, of which 5 aircraft joined us in June to continue with us for a period of 1 year. So during this, we used that to deliver the promised ASK of 22%, which we took it, we operated the aircraft, and we delivered all the promised results until September. Mid-September, the leasing company of the wet lease aircraft, they approached us and they said they wanted to terminate the agreement on the wet lease in mid-September. So they operated the aircraft during the peak summer season, and they had a different engine type that they felt it's not very much suitable to Saudi market. So we agreed with them, and then we paused the wet lease aircraft. We immediately started again looking at wet leases. We are at the final stages of signing an agreement to bring 7 wet lease aircraft, and those are planned to come by on 1st December. We're at the final. We probably will finalize with them next week, but the plan is that they will start on 1st December and for us to resume the growth.
Ramzi, these wet leased aircrafts were returned by end of September, right?
Mid-September, 13 September.
Mid-September. So post second quarter, during the earnings call, you maintained your guidance as 6 to 18% growth in revenues. However, till now, 9 months, 25, we have recorded like around 3% growth in our revenue. So we understand that second quarter was weak due to one-offs. However, you maintained your guidance, and now for the third quarter, you haven't, let's say, recorded what was promised compared to the guidance that was, communicated after the fact of the second quarter. So
Yes.
my question is regarding the third quarter, there is something wrong happened within this quarter. Load factor is low, yield is declining, year over year is flat, however, load factor is declining. Q over Q, your yield is declining. That's mean you have passed on some discounts, or there is an issue with the demand.
Just, Omar, let me explain this. The wet lease in return of the wet lease in Q3 was sudden. We didn't know that when we had the earning call, the aircraft were supposed to be with us for a period of 1 year, and this was the agreement. Now, the lessor in 13, as I mentioned, in September, they came back to us and they said, we have an issue with the aircraft, and we agreed to return it. So that was not something that we knew.
Yeah, Ramzi, but in September, we know that it is a low season compared to July and August, right? So basically, most of your revenue should come from the first two months. Correct me if I'm wrong. And it is just 2 weeks, right?
No, I'm sorry, Umar, but even if September like low season, it's about capacity. September, there is like demand for like certain segment in the market, mainly for Al-Umrah segment. So we are talking about capacity rather than its demand side. So those like, let's say, aircraft, for example, the 7 aircraft, it was like due for unscheduled maintenance that make like, let's say, the wet lessor or the ACMI operator in need to take those aircraft, which is fine with us. and we are replacing like the capacity with another, like, let's say, operator, which is part of our like always our operation. When we face like some issue here and there, immediately we have like alternative. The most important point is that we are committed like to achieve certain growth. If we couldn't achieve it, we try to navigate into like, let's say, term of like cost side, or doing like any opportunity, trying to capture it in order to achieve our target.
Clear.
Omar,
And
yeah, sorry. You know, in Q3, the growth in Q3, as we explained, was 22.5% in ASK, which is a very, very high growth. And the results of Q3 are better than Q3 last year by 15%. The bottom line.
if I'm not mistaken, bottom line, okay.
Yeah.
بس التوب لاين كان على تقريبا 6%. So all of
6%
this
top line,
ask did
bottom line
not
15%.
translate to better revenues. So my second question, I mean, have we passed some discounts during this quarter to stimulate demand?
For what? For the ticket, you mean?
Exactly.
Well, the major, and I think the major item that impact like the net ticket price is the new fees introduced by GACA, which really we couldn't pass to the consumer. It's a dynamic, like, let's say, work. I mean, the pricing. When you look at like, let's say, especially for like, let's say, the booking curve of the Saudi market is very short. You're talking about 7 days. So it's very hard really to anticipate how much you can pass to the consumer or the passenger, or no, you can keep it. So it's not like an easy exercise. So for like, let's say, July, yes, for example, because of like the geopolitical tension, all airlines, not only Flynas, they discounted the ticket because people, they were like not making like any reservation. They tried to discount the ticket price, etc., to stimulate the demand. But in August, it was like very strong. People, they come back and they start like making the booking, and we anticipate this trend to continue. I mean, we are not expecting any major now negative trend to happen in Q4, for example, or even for next year. In fact, our expectation for next year is very strong here, and that's why we are building a good capacity with retaining our aircraft at its AOG with CFM. In addition to that, we are adding more like with lease, because we see like a great opportunity in the market that we need to capture. So in terms of like, I go back to like Q3, it was very strong quarter in terms of like profitability. There is some challenge, headwinds here and there, but we are able really to maneuver and to handle them in the best way.
Clear. And what was the reason for the increase in maintenance cost during the quarter under the cost of revenue, and يعني, how many aircrafts يعني, were grounded during the quarter?
Yeah, well spotted. I think you see that there is, I think, 38% increase. And the increase in maintenance cost, Omar, was when in Q3 we flew, as I mentioned, 22.5 ASKs higher than previous same period last year. And there is the CFM is a variable rate. We have the power by the hour on CFM. So we pay by hours, and also the number of hours increased by approximately 20 to 22%. So that's part of it came from the hourly charge for CFM agreement, and the other part came from higher freight cost during the quarter for engine transportation.
And how many aircraft were grounded during the quarter?
Around 7 aircraft. Yes.
7.
Yeah.
And based on my understanding now, so basically during December, we'll start with leasing again, right? 5 different or 5 additional aircrafts, right? Isn't it? So 5 additional with leased aircraft.
We lost.
3.
Sorry, Omar. Can you repeat, please?
Sure. So based on my understanding now, 5 additional, let's say, wet leased aircraft will be added to the fleet starting from December, right?
Yes.
7. It's up to 7.
Seven?
Up to 7
Up to
aircraft, as we
7.
mentioned. And Omar,
So-
sorry, we have to give a chance for others to ask
Sure,
as well.
sure. This is the last question. So
Yes.
basically, based on my understanding, Q1 and Q4, basically in aviation, it has a negative seasonality compared to second quarter here in Saudi and third quarter. So why are we wet leasing, these additional aircrafts? Is there, say, a strong demand that have led, you to have these additional aircrafts?
No, those like aircraft, it's not only for Q1 and Q2. This is like for full year. Okay,
It
for
will stay till the
full
next
year.
December, right?
Yeah, it's will cover like the summer, etc. And let me stress on something.
Mhm.
The market is really growing, and for us as a Flynas and a low-cost carrier, we see like a great opportunity to capture. Look, for example, what we did in terms of like a new market, Syria, as an example, and Russia. When we start like the operation to Syria, we start like, let's say, from Riyadh, followed by Jeddah, then Dammam, Moscow. It's the same. We've started with Riyadh, and within first in December, beginning of December, we start from Jeddah to serve al-Umrah. There is a great opportunity still in the market. There is certain destination that is either unsaved or underserved. And our responsibility as a Flynas, we see like a great opportunity, and we need really to move very quickly to capture that. So we are taking like the wet lease to accelerate our growth, while our aircraft will be back to like, let's say, to the normal in terms of like the average AOG at the beginning of Q1. However, the growth that we need really to capture the growth and the opportunity in the market.
Very clear. Thank you, management, for the presentation. Much appreciated.
Thank you, management. Ladies and gentlemen, please limit yourselves to 2 questions maximum, as we can allow time for other participants. Now, our next question comes from the line of Mohammed Al-Rashid. Mohammed, please go ahead. You're unmuted. Yes, you're audible, Mohammed. Go ahead, please.
Mohammed, we can hear you.
Can you hear me now?
We can't hear you now. You can't hear Mohammed. Okay.
Can you hear me? Okay.
Yeah, I can hear you. Yeah.
Yeah, so the first question is regarding the 2026 guidance. So I understand that 2025 there was a certain temporary factor that impacted your ASK growth. But looking at your 2026 guidance and comparing it to the IBO guidance, actually now you're expecting 2026 to be lower than your initial business plan by 8% in terms of revenue. Since this year was mainly impacted by temporary factors, we should expect that 2026 will have a higher revenue growth to be in line with your previously communicated business plan. So can you please explain what are the drivers behind expecting lower revenue for 2026 compared to the initial business plan?
Yeah, Muhammad, we explained in the presentation, the CEO explained the reason for the lower revenue. So the reason for the lower revenue was the grounding of the due to the CFM issues, which we mitigated through a wet lease, but then we had to pause the mitigation, and which starting again in December, we will get 6 to 7 aircraft so that we can resume the planned growth. Yes, you are right. So there'll be by end of 2024. By end of 2025, you will have, as you see on the slide, the revenue will be 7.6 billion, and then it will grow by 2.5 to 4.5%. And then next year, we will grow by 16 to 18% based on we're having additional 5 new deliveries will deliver from Airbus in 2026. as well as we will take our wet lease in total will be around 10 aircraft in 2026. So that will bring the 16 to 18% growth in 26.
Yes, and this 16 to 80% would result in 9.2 billion revenue for 2026, while your original target was around 10 billion for 2026.
Well, I didn't calculate it, but if you did,
That's the
it.
question, because basically we understand 2025 there were temporary factor, but for 2026, since you will receive the deliveries and you secure the wet lease by December, we should expect a higher revenue growth in 2026. So is there another things maybe driven by lower demand, lower expected load factors?
Yeah, okay, fine. All right, yes, I understand this. You calculated, I did not. I'll look at it. If it's different, I'll send you an email on this.
Okay, thank you. My second question is regarding the load factor. Can you please shed some light? How was the load factor prior to the wet lease redelivery by September 2025?
Sure. Wet lease has nothing to do with Mohammed, with the load factor. The load factor is being impacted because of like what's happened in Q2. Q2 has impacted the load factor, where we see like around 13% drop in the load factor because of the tension, the geopolitical tension. In addition to that, the suspension of visa has impacted the international traffic significantly. Those are temporary incident. It's not like permanent. And we see now the rebound coming, like, let's say, to the load factor. So we expect like the load factor to be very strong. We see it like, in fact, for August, as an example. July, unfortunately, I can tell you the tension that happened, the geopolitical tension that happened in June has like the impact has extended to July. And this, as I mentioned, impact all airlines. It's not only for low cost or Flynas or the Saudi carriers.
Can you please,
Mohammed,
how
as
much
we
the load
mentioned-
factor in August and September versus July?
Mohammed, actually, we have to limit the questions to 2 for each participant. So I apologize, but thank you. We have a question from the line of
Yes.
Giuseppe. So Giuseppe Valerie, please go ahead. You are unmuted. Hello, Giuseppe.
I think just to mention, to reply about the load factor in July, it's reached 88 to 89%. Sorry, in August. Okay. Any further question?
That's clear. Thank you. I think, Giuseppe, we can't hear you. So we have a question from the line of Ma'an. We will come back to you, Giuseppe. Ma'an, please go ahead. You are unmuted.
Hello?
Yes, we can hear you.
Yes, hi. Thank you, first of all, for the presentation. Two questions from my end, if I may. The first one regarding the new GACA cost, ABC. How much was it like on absolute basis this quarter compared to last year? And how much was the increase as a figure? Or is it per passenger, or is it per flight? If you can shed more lights on that, please.
Yeah, it's per passenger for international departure, 30 riyal additional. It used to be 130 riyal. Now it becomes 160. Usually in airline, when there is like increase in cost, it's not easy to pass it to a consumer or passenger. It takes time until, like, let's say you start or the market start absorbing this. So the impact right now, we expected really to reduce in the next like a few months. But the first, like, let's say at the beginning, like when they introduce like a new fees or charges, etc., usually it hit the airline.
Okay, and on absolute basis, how much was it during this quarter compared to last year's quarter?
An absolute? You mean as a
Yeah.
number?
Total amount.
If you take it roughly 4 million passenger in Q3, around 50% is international, and out of that, departure is 50%. So you are talking about 1 million passenger to 1.2. So you're talking about 30 to 35 million impact on our net profit.
Okay. Okay, understood regarding this question. My second question regarding your guidance for the full year of 2025. If you look at the 9-month net margin, it's around 8%, but you're expecting that basically the fourth quarter will be almost very thin margin. What's driving that for the fourth quarter?
Yeah, first of all, we are very conservative. Yani we'd like to be like conservative rather than putting like or leaving it like with a higher number. But
it's the seasonality. It's we have the highest margins by Q3, and then it drops down by Q4. This is normal every year, and that's why we guide as an average for the year.
Okay, thank you. Best of luck.
thank you.
Thank you, management. Our next question comes from the line of Sayed Akhtar. Sayed, please go ahead. You're unmuted. Sayed? Hello? Okay. We'll get back to Sayed, or you can type your question in the Q&A chat box. Our next question comes from the line of Mohammed Isnayan. Mohammed, please go ahead. You're unmuted. Yes, we can hear.
Yes. So just following up question on my colleague's question on the 2025 guidance. So you're guiding for at the higher end of the guidance. It seems that you're estimating the fourth quarter to be loss-making by around 35 million riyal, which is a trend that we have seen back in 2024, specifically on the fourth quarter. So should we expect additional expenses to be booked on the fourth quarter, especially when it comes to the maintenance expenses and the interest on these liabilities?
I think no. Muhammad, we have given you the guidance for the results for Q3, and we have given you the guidance for full year, including all the costs built in.
Yeah, but is it fair to assume that the fourth quarter will be loss-making at the higher end of the guidance?
Yes. Yeah.
Okay. Yes. That's clear. Thank you.
Thank you, management. Our next question comes from the line of Renad Shahri. Renad, please go ahead. You're unmuted. Renad, can you hear us? We will be taking another question. So our next question comes from the line of Klaus Berglund. Klaus, please go ahead. You're unmuted.
Gentlemen, Klaus at Citi. So first on these CFM issues, we had the issues on the Pratt & Whitney side impacting other airlines. So why do we see these issues on the CFM side sort of spreading? Is it the shift over to CFM from Pratt & Whitney creating bottlenecks globally, or is it something else? And what gives you the confidence that this will be solved by the first quarter? I hear you on the new lesser agreement from December, but what about the underlying issue with the engines? What are you hearing? And then my second question is on the lesser agreement, the actual terms. I'm a bit surprised that this could be cancelled on such short notice unless there is force majeure. So what was the problem here? And will the terms be different under the new agreement from December, i.e. more difficult to cancel? Thank you.
Regarding the CFM, the issue, it's a peak for Flynas this 2025. The reason behind that, 19 aircraft received in 2023. All the engines in 2023 due to overhaul in 2025. But the challenge was to supply enough spare engine by CFM. CFM facing like an issue with the TAT, which is the turnaround time. Instead of like, for example, 60 days, because of the shortage capacity in the MROs, it takes about 200 days and more. So they start supplying the spare engine, but it's not enough really to our requirement. Now, all those like 23 or 19 aircraft already been overhauled. So there is nothing major in 2026. In addition to that, a significant improvement and development made in the engine of CFM, where is a certain upgrade. So the time and wings for the engine will stay further and much, much better than previously. So a couple of factors that happened that affect like this year, and those factors really making a big comfort for us for like the next years. So the things that happened for this year, it was like, let's say, the peak for the CFM that facing like Flynas. So based on like our planned removal and the spare engine that required and etc., things will change dramatically and at the beginning of 2026. In fact, we start seeing this even starting from now.
As for the your question on the termination of the wet lease, we have a strategic relationship with the leasing company. This leasing company also provides us with the wide body, like 10 or 12 wide body aircraft every year for the Hajj operations. So they had an issue based on their engine type on the hot and harsh weather. It wasn't, they operated, they realized that there was a significant deterioration and they were doing for us some short sectors as well. So although we had an agreement for them for 1 year, but we can't force them to continue, or that there is no penalty to come out of that. So we understood their situation, and we terminated, and we immediately moved on to other operators with the more suitable engines to the environment here. And we're at as we mentioned, we will get the aircraft by first week of December.
All right, thank you.
Thank you, management, for that clear answer. Next, we have a question from the line of Aqib from BSF. Aqib, please go ahead. You are unmuted. Okay. We will now try Rinad. Rinad, please, if you can try to unmute yourself again and ask your question. Yes, you are.
This is Rinad Al-Shahri from Al Jazeera Capital. Thank you, management, for the presentation. I have a question regarding Hajj and Umrah and general aviation. I understand that in this year we faced a little bit bumps when it comes to the visa restrictions. However, can you share with us your outlook for year 26, specifically for Hajj and Umrah, and if those restrictions maintain, is there any strategies or plan to mitigate those risks? And as for the general aviation, I understand it's a small portion of the overall, but as we saw in this quarter, there's approximately 26 decrease. Is there any effect from the competition of, or like the new entry of the foreign operator, specifically in the general aviation?
Let me start with general aviation. It's very small part in our portfolio. It's not like having like any big potential to grow, etc. So it is seasonal issue. Sometimes with one aircraft or two aircraft, you will find like a jump of like 20 or 30% increase in net profit. So it's a small part in our portfolio. Regarding Al-Hajj Al-Umrah and the suspension visa, there was like a lot of discussion with the government and the authority. They understand, like, let's say, the challenge facing not only the airline, even like other sector due to this sudden suspension. I don't think this will happen again anymore next year. So there will be like a plan what type of visa that will be suspended and etc. Because this year all type of visa has been suspended, and this was like a big like surprise for the market. So I don't think at all there will be such things will happen next year.
Yes, also on the, I recommend that you later have a look at the segmental reporting in the financial statements. You will see two things on general aviation and Hajj and Umrah. Hajj and Umrah year to date, we are 40% higher profits than last year. So this year was a very, very good Hajj and Umrah bottom line business for us. And again, if you look at the 9 month for general aviation, it's double the profit, although it is in absolute, it's small, but it's double the profit of last year. And you are right, for the quarter, it was the general aviation is seasonal as well. So it was a bit lower in the quarter, but for the 9 months, it is double the bottom line results of last year.
Sorry, but you mean for the general aviation 9 months 25?
Yes, if you look at the segmental reporting, 9 month 25, 9 month 24, you'll see that it's double.
Yeah, because I'm looking at the earning release and it's minus 11% for the 9 months.
On the bottom line, that's the revenue.
Revenue, yeah, the revenue.
Yeah, right. Exactly, right. But and also the Hajj this year is lower revenue than last year, but bottom line profit 40% higher. Similarly, if you look at the bottom line of the general aviation, you will see it's double the profit of last year. It's in the segmental reporting. Have a look at it. In the financial statements, it'll be on Tadawul and on our website as well.
Great, thank you very much.
Thank you, management. Can we take on one more question? Okay, so Agab from BSF actually has 2 questions. The first is like the reasons behind the visa restrictions. So could this be repeated in 2026? Like, could you please clarify on this? And his second question is regarding the pricing. Is it driven by government fees, or what's the driver for your pricing in attempt to maximize revenue per flight? Thank you.
or sorry?
Yeah, we're saying if the visa restriction.
No, as I mentioned, we don't think so. It was like a big surprise, and it was sudden, and was not planned or discussed. I think the authority, they understand the impact, the significant impact, not only in the airline business. When you look at like other businesses, like even the entertainment business, okay, there was like impact. So all sector has been impacted by that. So there will not be, I doubt, there will be something like that, okay, to happen. Okay, but at least we understand really the impact of such things in our bottom line, and if there is something, it will be communicated so we can plan our flight and schedule accordingly to the right market, rather than putting them in certain market which rely on international traffic.
Yeah, regarding your question on pricing, we mentioned several times before also that Flynas is one of the first early adopters of artificial intelligence on our revenue management systems. So we have been doing that for quite some time, and it's very successful. But the way it works, it reads the competing flights. It reads the history, same time last year, same day, adjusted multiple parameters. So our revenue management is very difficult for competition to spot our pricing, and it's optimized. And if at any time it doesn't bring the expected revenue for a certain flight, it goes to data scientists that with recommendations for a change. So we have a very sophisticated revenue management system in place.
Thank you, management. That's very clear. If I may, we can take one final question. So, Mr.
Okay.
Giuseppe, I think we should try again. Please go ahead. You're unmuted.
Hi, I hope you can hear me now.
Yes, you're audible.
Okay, perfect. So first question is on sale and leaseback transactions. What's your expectation for the gain on sale and leaseback for 2026? And then secondly, for new routes, how does financial performance compare with the existing network in terms of yields and operating costs? Thank you.
Yeah, the aircraft deliveries in 2026, they're all planned to be on debt equity. So you will not see sale and leaseback for 26. So that to answer the first question. The second question?
On the routes, as we said, we expanded our network, 7 countries, 9 destinations, and 19 routes in 9 months this year. Some of these routes are as per our Blue Ocean strategy, uncompeted exclusive routes. But most of the routes, the performance has been exceeded our expectations, including the summer routes, like for example, Geneva, Milan, Krakow, etc. But also the regular year-round routes like Uganda, Entebbe, Djibouti, etc. So all these exclusive routes, but even the other competing routes, performance has exceeded our expectations.
Yeah, thanks, Anurag. And when I answered you on sale and leaseback, I thought I assumed that you understood the objective of us going more and more away from sale and leaseback into debt equity. But just in 2 words, if we do that was part of our IPO promise to investors, that we will be focusing on improving the net income margin, and the way to do that, when we do debt equity, we depreciate the aircraft at 20 years rather than based on the lease term. We have the residual value of the aircraft. We finance rather than 100% of the aircraft, we finance a 80 or 70% of the aircraft. So we have many reasons that will improve the P&L when doing debt and equity.
But sorry, just to clarify, do you expect no gain from the transactions, from sale and leaseback transactions in 2026 then?
Sorry, we cannot hear you very well. You can repeat again your question?
Yeah, so do you expect no gain from sale and leaseback transactions in 2026 then?
I think he was asking if you expect new gains on sale and leaseback transactions.
No, we don't at all. We don't, as you see this year, as our sale and leaseback gain was much lower than previous years, and next year we do not expect to have any sale and leaseback gain.
Got it. Thank you.
Thank you, management. That's clear. Now, SNB Capital would like to thank Flynas' management for taking the time to conduct this call. We would like to thank all of the participants for attending. Now, I'll hand it back to management for their closing remarks.